The governments are now running through a proposal for established properties specifically, turn that CGT discount down from 50% to 25%.
You may shoot yourself in the foot if you plan to change this into an investment down the track.
We may find people holding on a lot longer than they actually would.
Imagine paying an extra $56,000 worth of tax if your property grows by $500,000. So thanks for joining me, everyone. And today I got no other than Big Shawnee here from Prop Spotter. Thanks buddy. Thanks for coming in.
Pleasure's mine, Tony. Always
Mate,
happy to be on the channel.
What's going on today? Hey, let's talk. What's the recent changes?
Taxes.
Taxes. We love taxes, don't we?
Oh, I don't know about that.
Hey?
I don't know about that.
Mate, you're paying too much these days, aren't you?
Oh, mate. Yes. Yes, I am. So are you, mate. Baz,
Oh, no, mate.
GST, income tax. It never seems to stop, right?
Come on. So, mate, I've got Shawnee in today because there is some proposed changes to the capital gains tax, right? So what is capital gains tax? It's the tax you have to pay when there's a profit made within your investment, okay? So it doesn't matter if it's property, doesn't matter if it's stocks, okay? You have to pay capital gains on it, right? No difference. Even if you don't have property, you don't have stocks, you have an interest savings account, right? And, you know, for example, if you earn $3,000 interest for the year, you have to pay taxes on that, right? So in a way, that's capital gains, right? So you have to pay taxes on anything that increases in value and you have a profit from there, okay? So Sean,
That's right.
to our audience, mate, what's the change?
So
What's the
long
change?
story short, currently you have a 50% discount on any capital gains made through property, only when you've held the property for longer than 12 months. The governments are now running through a proposal for established properties specifically, turn that CGT discount down from 50% to 25%.
And that eats up your profits, doesn't it?
Well, like Tony said at the start of this video, that's an extra $56,000 whenever you've made a $500,000 profit. I think it's important to note that this proposal is actually split into two. Anybody who buys before X date, a date that's yet to be announced, will have their CGT discount grandfathered. Anybody who bought between when CGT first got implemented in 1985 to X date, good. Anybody who buys after X date, an established property, will have that 25% discount instead of 50%. However, here's the kicker. If you add supply, so that means you're adding extra houses to the existing house network here in Australia, you will still retain the 50% CGT discount. So that means if you buy an off-the-plan apartment, if you knock off a home and land package, if you buy a plot of land and build a house yourself, you will still get that 50% discount. And so that may also have impactful changes on the Australian property market. In today's episode, we're going to run through exactly what these changes are, how they impact you, and run through hypothetical real-life scenarios on what that could mean for you down the track.
So in a way, it's going to drive up prices in both ways, right? On the investor side and owner-occupier side, right? Because if you think about it, me as an investor, I want to get in there ASAP before the changes come. So I save myself a lot of taxes, right? But another side is, hey, do you know what? Some owner-occupiers out there that's buying their first home might think, oh, do you know what? I might just wait for these changes to come in first, right? But they have to understand, if you want to keep this property that you're going to buy as an owner-occupier and potentially change it to an investment down the track, then you can still claim that 50% CGT, correct?
You may be able to.
Correct,
Yeah.
right? In a way, right? Logistically, right? What we're seeing. But if you wait until you buy your owner-occupied property, when the proposed changes come, if it even comes, then therefore, you're not going to get grandfathered when you change this property, owner-occupier, to an investment.
Yep.
Correct, right? So for you owner-occupiers out there that, you know, want to play around the market and thinking, hey, do you know what? I'll wait until the proposed changes come in. You may shoot yourself in the foot if you plan to change this into an investment down the track. Okay, so this is a FYI. Okay, but you know, the way I see it, it's going to change both ways. It's going to drive prices in the investment side of things and the owner-occupier side of things, in my opinion.
Yep. I think there's also a few considerations there, right? Like from an established property perspective, there's a few ways this could play out. If the discount is grandfathered, we may find people holding on a lot longer than they actually would prior to them selling. And so that could reduce the supply of established properties being sold on the market because investors are out there holding on to them for when they really, really, really need to sell.
Yep. Now, did you touch a bit on if it's a new build? What happens if it's a new build?
Yeah, so if it's a new build, as we mentioned earlier in the video, you get a 50% CGT discount and that stays the same. You get that today, and if you continue building a new house even after this bill is implemented and put into force, you will still continue getting that 50% CGT discount.
So it doesn't matter if you do a knockdown rebuild, doesn't matter if you develop your land, is that correct?
I'm not sure how it applies to knockdown rebuilds specifically, but if you buy off the plan apartment, if you buy a home and land package, or if you buy an empty block of land and you build on it for the first time, you you will continue to retain your 50% CGT discount.
So builders are going to be making bank, wouldn't they?
Look, I think there's a few ways to play this out, right? First of all, we have to look at it from an economic perspective. Most new estates come on very small blocks of land today.
Correct.
And so if we ran through that hypothetically, you could essentially, let's say, build in Metro Melbourne today, a double-story house, and that set you back 800 grand.
Yep.
Now, however, your land content is so small that it's unlikely that your prices are going to fly through to the roof. Now, while you get the 50% CGT discount on this, there may be a world in which the price hasn't actually gone up that much for that 50% discount to really give you much of a discount.
Yep.
On the flip side, you could buy an established house 1 or 2 suburbs over with triple the land content.
Yep.
And that land could highly appreciate. And even after paying and, getting 75% slapped on your CGT bill, you could still be better off. And I think that's something we should actually get into today so that our viewers know what the changes could mean for them and what the implications could mean for them.
Yep.
Because I can already sort of see into the future and predict that there'll be a whole bunch of off-the-plan home and land package developers that will incentivize you to buy and use that discount as the biggest carrot.
Right.
On the
So
face of
let me break it
humanity.
down a little bit more. Okay. So let's just say you buy an empty block of land, right, for 300 grand, argument's sake. Yeah.
Let's go for that.
And your bill is going to be $500,000.
Yep.
Yeah. Now, over time, because the land is so small, it doesn't increase in value as fast as it should be. But at the same time, is your dwelling actually decreases value as well.
Correct.
Right? So, for example, your land could increase by 50 Gs every year, but your bill could be decreasing by 10% every year, right? So you're slowly eating each other out so it doesn't move. That's what you're trying to say.
That's what I'm trying to say. But also, like, if we look at it from an actual perspective, 250 square meter land, using your example, $300,000 for the land, $500,000 for the bill. So you're all in for $800,000 today. That $800,000, let's say it becomes 1.1 mil after 10 years.
Yep.
Right? In the neighboring suburb, you spent $800,000 today.
Yep.
And you bought 700 square meters of land.
Yep.
That then increases to 1.5 mil.
Because
in
the
that
land
same
value,
time period.
because the land value of that purchase price is called
Correct.
80%, and the dwelling is only 20%.
Correct.
Yeah?
And so now you've put in the same amount of money in both scenarios today. In scenario 1, you end up with $1.1 million before we talk about tax.
Yep.
In scenario 2, you end up with $1.5 million before we talk about tax.
Yep.
Right? Now, what happens when we add that tax layer in? Let's run through that. Right? On the $1.1 million scenario, yes, we're not going to detail with agent fees, interest, and the whole jazz. We're keeping it simple here. On that $1.1 million, you'll only be taxed on $150,000.
Okay.
So that $150,000 gets added to your taxable income. If you're an average Joe out there, let's say on a $100,000 salary, that's a $250,000 taxable income for the year. Let's pause it there.
Yep.
Right? In the second scenario, where that property is increased by $700,000, right? You now have a taxable income of $625,000 for that particular year, right? So scenario 1, taxable income of $250,000. Scenario 2, taxable income of $625,000.
Yep.
Sure, you'll be paying more tax, but you also made more gains.
Yep. You've got more profits at the end. Yeah.
That's right. And that's the reality of what this situation is, right? Land appreciates, buildings depreciate. And the government is trying to incentivize supply to ease the housing crisis that we've got nationwide and support all the new migrants that we're bringing into this country.
Well, it's not just that, right? You're supporting
The building
the
industry,
building industry,
the real
right?
estate
It's not,
industry.
not just the building industry, but it is the building industry because under the builders, you got all these tradies, right? And when you talk about tradies, you're talking about, your painters, your plasterers, your electricians, your plumbers,
The list goes on.
right? But under that is all your suppliers as well, right? So you got your tradies, you got your material, the people that supplies the material. So it's like a domino effect, right? So everyone's going to take a clip off that build.
That's right. And let alone the real estate agent on the other side that's going to sell it, and the
they make
property
too-
manager
they-
on
they
the
really make
other
too
side
much.
that's going to the property manager on the other side that's going to manage the property once
Yep.
you've bought it, right?
Yep.
So there is a whole industry there that's going to continue to be supported.
Yep.
However, you as the investor will most likely be taking a much lower return.
Look, I've done some numbers before this podcast, okay? So I've ran it here, right? Now, let's say, for example, I purchased a property for $500,000 today, okay? Before the proposal of the new CGT, okay? And let's say for argument's sake, in 10 years' time, I sold it for $1 million. So I got $500,000 in profit right there,
Yep.
okay? Now, I'll get a 50% discount on that $500,000 profit. Okay, so if 250 is tax-free. The other 250 is added onto my taxable income. Okay, and when I do my tax returns, and if my income's 100 grand base,
Yep.
I got to add that 250 onto my base, so which is 350. So for that financial year, my taxable income is going to be $350,000. Okay, so the tax I'm going to pay is going to be 123,000 and some change, right? That's pretty big.
Not immaterial.
Pretty big, right? Now, if I was to buy this property after when the new proposed changes come, what happens is only 25% of that 500,000 is tax free, which equates to $125,000. So 125,000 of that 500,000 is tax free, but you're gonna get taxed at $375,000. Okay.
Your total taxable income, though, I think will rise to
Yep, 475,000.
Correct.
All right. So now, if I was to do my tax returns, I got to add 375 onto the $100,000 PAYG income I receive.
Yep.
And now my tax bill is just under $180,000. That's a difference of 56,000 and some change.
That's right. And like,
And some
got the
change.
calculator here, okay? And on that $500,000 gain, in scenario one, you were paying $123,000 in tax. That's inclusive of your job income because you got to work a job to pay the bills. 123 divided by 500, if I just look at that in aggregate, that's 24.6%. Now, in the new scenario, it's 179 grand. Again, divided by that same 500, it's 35.8%, almost 36%. And so you work the same job, you made the same gain, the government's going to take your tax rate from 25% aggregate to 36%.
Welcome
An
to
11%
Australia.
increase.
Hey, welcome to Australia, right?
Better hope we clean up those potholes in the roads.
Mate. Okay, so mate, let's talk about a few things then now. So if enforced, let's talk about worst case scenario. Okay, if enforced, what do you reckon is going to happen to the property market?
Off the plan builders and apartment sellers and home and land package guys, they're going to be drooling at the lips. Okay, they're going to be licking their lips. They're going to be salivating the amount of content that's going to come out on YouTube and Facebook and everywhere else.
Yep.
Saying, buy a new house because you can get
Yep.
a huge discount in your taxes and
Yep.
save on your tax bill is going to be through the roof, number one. Number two, I think realistically, the first shock is that every investor out there is probably going to, without thinking and running through the numbers, get enticed by that new home build and new land packages. So in that, let's say 12 to 24 month time period, we'll see established homes take a little bit of a slowness to their growth rate, right?
Yeah.
So suburbs that were growing at 20%,
Yeah.
25% year on year, they'll probably start to grow at 5 to 10% instead, depending on where they are and how they're doing.
So growing at a decreasing rate in comparison to today, yeah?
Correct.
Yeah, so it's still going to be
Correct.
growth there, but not as, your 15, 20% what we used to seeing in different states.
That's right. But you know what the joy of property investing is? If you're in a landlocked suburb, people still need to get to their workplace. That's never going to change.
Yep.
Their work is still increasingly in and around the CBD areas of capital cities. And so the renters in the market will want to rent close to where work is. And if you're in a landlocked suburb somewhere in the city, let's say if we look at Melbourne, Footscray, St Kilda, places like these, your yields will continue to go up.
Yep.
Even
Yep.
though the property prices may take a slowness to their growth rate, yields will grow up, rents will grow up, and essentially investors will then get appeased back by those markets because the yields will become overwhelmingly high.
Yep. But you know what? I reckon a lot of developers will also be knocking on the doors of the existing properties, right? Knocking on the door. If the land's big enough, hey, you know what? Maybe I can build
Apartments.
apartments or
Townhouses.
townhouses or even duplexes, right?
Yeah.
So organically, for investors that's holding on a big block out there, the price of your property could also increase significantly as well.
Your time may come soon.
I know, right? So tell me, most likely you'll probably see a good bunch of new investors going to divert to new builds. Most likely.
I think
yeah?
uneducated new investors will most definitely divert to new builds.
Yep.
I'm not saying new builds don't stack up. I think where you can get large enough land content
Yep.
on your new build in a good landlocked suburb
100%.
or a suburb that's building out pretty quickly, it becomes a no-brainer.
Yep.
But nothing when it comes to capital growth can really beat an established house with development potential on the
100%.
block.
Look, like I said, right, that's right. The house and land is not the worst thing around as long as you got a big enough block. And plus, because it's a brand new build, there's a lot of depreciation you can claim back as well.
Correct.
And that's also added benefit.
That's
yeah?
right. If you're doing a house and land on 600 square meters, there's nothing wrong with that.
Yeah.
It's the 250s or the 168s that I've seen in some places. They can really come back to bite you.
That's disgusting. But look, Sean, I think, in the next 10 years, 15 years, I do feel duplexes, townhouses, villas will be the norm for a lot of first-time buyers.
With the way we're going in this country, it doesn't surprise me. I mean, not everybody can get a house. In the 50s and 60s, the house was the norm.
Yep.
In the 70s and 80s, we started moving towards townhouses and villas and even apartments in some key suburbs like Bondi
Yep.
here in Sydney. And now, in 2010, apartments were the norm in Parramatta, and now they're becoming the norm anywhere else.
So, mate, thanks for joining me today. So,
Pleasure.
any final wisdom, mate, you can give to our clients?
Don't know about wisdom, but I think, always assess your property investing on a deal by deal basis. If you ever need to speak to an expert, Prop Spotter and the team are here. But otherwise, best of luck on your property investing journey.
Mate, what a plug. Hey? Okay, so there you have it, everyone. Some big changes once the new government's going to come in, or proposed changes, as you'll see. Now, as always, please look at all my videos on my YouTube all the way up here. And also Sean from Prop Spotter has a lot of videos up here for you to look at as well. As always, thanks for joining me on another episode of the Mortgage Chat, and we hope to see you next time.